I'm Lady Lee Clinton. Let's talk about a plan for reasonable taxation in the United States of America. There have been numerous attempts over decades to reform and simplify the tax code. Tax law has become so complicated that many individuals must turn to a professional for help in filing their taxes. There is confusion on what can be claimed as deductions. Cost of living in certain areas is not considered. Currently, the United States is not collecting enough taxes to cover the yearly budget. This proposal, which is based on social capitalism, would ensure a fair and equal tax on all individuals and businesses that claim primary residence in the United States of America and foreign businesses that control production or services in our country. It would also meet the needs of those individuals and U.S. businesses that are not making enough income to meet their real costs. All individual tax returns would have the same calculation for net gain regardless of filing status: single, head of household, joint. All individuals over the age of 21 would be required to file unless included in a custodial filing. Individuals under 21 would only be required to file if they are not living with a custodian or if they earn over $10,000 gross income from all sources in a calendar year. For all those who meet this requirement, even if they have little or no income, filing would ensure their ability to gain subsidies through local, state, or federal funds if their net gain is below $0. Net gain for individuals is calculated by taking total income from all sources, wages, tips, investments of all kind including interest earned, inheritance, sales of made goods or provided services exceeding $100 a year. Minors under 21 would be excluded from this requirement. Sales of property and luxury goods such as jewelry, loose gems, precious metals, or other collectibles where the value of the sale is over $1,000. And all other income except government subsidy for all members claimed on the tax return. Then subtract real costs: mortgage or rent payments on primary residence, utilities of the primary residence, auto maintenance on the primary vehicles, transportation for work or school such as bus fees or necessary business travel not paid for by employer, child care, education including tuition, books, and supplies, insurances such as auto, health, and life, 1/2 the cost of elective medical procedures, minimum payments on debts plus 10% of total debt excluding mortgage, employee taxes, state and local taxes, an adjusted consumable amount based on location that includes food and necessary personal and home items, and emergencies where costs are not covered by insurance proven by receipts. This equals net gain for an individual. All businesses would have the same calculations for net gain regardless of type. S companies would be eliminated because the business calculation includes payments to investors and stockholders. Owners of businesses would file their income as individuals. This would apply to all businesses that have offices or do business in the United States, both foreign and domestic. Small businesses run out of homes and farms would be exempt from claiming expenses twice. For example, a farmer who sells goods would be considered a business. If the family lives on the property and pays utilities, the cost of the mortgage or rent would only apply to the business expenses and could not be claimed on the individual deductions. The cost of utilities can only be divided if the utilities are actually split into separate payments, as in a separate electric meter to serve the house, while another serves the rest of the property. For small businesses run out of a personal home, certain expenses can only be claimed as individual tax deductions and cannot be claimed as business deductions. Any individual who makes less than $1,000 is exempt from filing as a business, but all profits must be included in the individual tax filing. Net gain for a business is calculated by taking total income from all sources, gross profits including domestic and foreign, investment returns, all other income except government subsidy. Then subtract the real cost, employee wages and contractor fees, employment taxes already collected such as FICA and W-2 withholdings, payments to shareholders or investors, insurance, mortgage or rent payments, utilities, consumables such as office products, production supplies for manufactured products, shipping costs, maintenance on equipment, minimum payments on loans plus 10% of total loans, excluding mortgage, capital investments to increase production or labor force in the United States only, employee services such as childcare, transportation, or business cost, product or service research, 1/2 of the advertising costs, and state and local taxes. This equals net gain for a business. Excise taxes are not included in business deductions as they are placed on the final cost of a product that the consumer is required to pay at time of purchase. Import tariffs or taxes can only be included in production supplies if the material or component cannot be acquired within the United States. To meet the needs of the federal government, taxes are assessed based on the calculated net gain for both individuals and businesses. Federal taxes would be equal to 50% of net gain over $10,000, 60% of net gain over $100,000, 70% of net gain over $1 million, and 80% of net gain over $1 billion. Net gain less than $10,000 owes no tax. In other words, an individual or business with a net gain of $20,000 would pay $5,000 in federal income tax, while an individual or business with a net gain of $2 million would pay $1,285,000 in federal income tax. While that sounds like a lot, keep in mind that all of their real costs have been met and they still have a considerable gain. All nonprofit organizations would be required to file as a business. Included in income would be donations received. Included in real cost would be a report of funds distributed that must match the stated goal of the nonprofit. If net gain is greater than $5,000, the organization will lose nonprofit status. Nonprofit organizations do not qualify for shared federal subsidies. If net gain is less than zero, then individuals and U.S. businesses are eligible for shared federal subsidies. These would come from the collected income tax. Shared federal subsidies for individuals would be equal to necessary costs, mortgage or rent payments on primary residence, utilities of the primary residence, auto maintenance on the primary vehicles, transportation for work or school such as bus fees or necessary business travel not paid for by the employer, childcare, education including tuition, books, and supplies, insurance such as auto, health, and life, minimum payments on debts excluding mortgage, employee taxes, state and local taxes, an adjusted consumable amount based on location that includes food and necessary personal and home items, and emergencies where costs are not covered by insurance proven by receipts, minus the amount of deficit of net gain. In other words, how much does the individual or family need to make up the difference between income and necessary costs? The deductible amount for consumable goods will be calculated based on the number of individuals claimed in the household, multiplied by a reasonable estimate for food necessary for a healthy diet, necessary personal items, and essential housekeeping items. This is adjusted for the location of the primary residence, which is similar to a cost of living adjustment given to federal employees when determining their salaries. Base rate at current prices would be about $600 for food, $100 for personal hygiene, and $100 for household needs, for a total of about $800 per person for 1 month. This would then be adjusted by location and number of individuals in the household as listed on the tax return. It works the same for businesses. Shared federal subsidies for businesses would be equal to necessary costs, employee wages and contractor fees, employment taxes already collected such as FICA and W-2 withholdings, payments to shareholders or investors, insurance, mortgage or rent payments, utilities, consumables such as office products, production supplies for manufactured products, maintenance on equipment, minimum payments on loans excluding mortgage, employee services such as child care, transportation, and business costs, and state and local taxes, minus the amount of deficit of net gain. Individuals and businesses receiving shared federal subsidies would not be able to take out new loans or move to a new home or location of greater cost. This prevents the misuse of these funds. Shared federal subsidies will replace some current programs like food stamps and housing assistance because these items are covered by shared federal subsidies. This program would also replace current Social Security for the elderly and disabled, as they would be covered if their individual net gain is less than zero. The funds in the current Social Security Trust Fund, which is scheduled to run out of funds by 2034, would be transferred over to the Shared Federal Subsidies Trust to be maintained by the Department of Treasury and distributed through HUD. No other tax exemptions will be allowed. Rather than having standard deductions that don't fit most individuals, families, or businesses, the calculations of real costs fairly distribute the wealth of the nation while encouraging businesses to invest in the U.S. labor force, yet ensuring both individuals and businesses can meet their necessary costs. I'm Lady Lee Clinton. Thank you for your time.